I'm happy to bring to my podcast the microeconomist from auction.com, Daren Blomquist. Daren was a part of my podcast this year already. He has tremendous knowledge on the trends, on what investors are looking for, and what consumers are doing in 2024, prior years, and what he expects to be in the future. We're going to talk about the consumer behavior, the real estate wealth in the United States, the investor behavior, inventory, delinquencies, soft versus hard lending. I think that's the charts that Daren presents are by far the best in the markets, with a lot of analytics and guidance to what we should expect in the 2025 year with the new presidency in the White House. Daren, welcome to the show.
Yeah, thank you, Alex. It's great to be back and great to have some more certainty. I think that's the biggest thing for our buyers on auction.com and other investors out there is we're just waiting for this election to be over so we could have some certainty about what was going to happen going forward. And so it's great to be back and be able to talk about this. Yeah, I mean, I think for sure a lot of the indicators in the economy still look really good, the macroeconomy. And it looks like the Fed is accomplishing this unicorn feat of a soft landing coming out of inflation. It's still not, who knows for sure when we can call a soft landing, but we're pretty close to a soft landing. Now, I think the question is how long will that soft landing last once we're there? But we're definitely in that place. I think things are looking, I do think we'll see a kind of Trump bump, so-called, or just a election bump from having the certainty from the election in terms of housing demand out there. So those are some of the top line things that I'm seeing.
In my mind, there's sort of a opposite scenarios that makes me feel that I don't see soft landing. Maybe you do, but the reason why Trump was elected is people feel bad about the economy, right? That was number one issue in their mind. The credit card delinquencies are up. The unemployment rate is growing. People feel uncertainty. There's wars out there. It looks like, with the Trump presidency, you're going to have some tariffs on China and European goods. That's going to drive the prices up. That's going to drive inflation up. All these programs will translate to sort of inflationary environment in the beginning. So a lot of those factors, in my mind, will actually impact the economy in a negative way, unless you see something different that would imply that soft landing is still in play.
Yeah, well, excuse me, when I say soft landing, I kind of fall into the trap of sitting in the ivory tower as an economist and looking at the data and not actually recognizing what's going on the ground. And I think there are kind of two realities. When you look at the data, a lot of the data looks good. I mean, unemployment is still low. It's gone up a little bit, but the job market is doing very well. Inflation is coming down. But of course, people, including us, if we're experiencing this, know that just because inflation is coming down doesn't mean that we're still not paying a lot more for stuff than we used to 4 years ago or 3 years ago or whatever. So, yeah, I think I'm speaking a little bit more on a theoretical level, is that the soft landing being that from the Federal Reserve's perspective is that they have mostly successfully fought inflation and brought it down without triggering a recession yet. Now, I do think, again, I get back to what I said earlier, is how long will that soft landing last is another question. And I think there's a lot of emerging risk that point to either, as you said, rising inflation or possibly a recession. It's really intriguing to me to see what the Trump administration prioritizes, and if they prioritize some of that more inflationary policy that you were talking about, such as tariffs and just spending, or if they prioritize more of the government, cutting government and pulling back on government spending. And I do think it's really important. I think that the Trump administration does really want to see lower interest rates, but how they would get there with some of the policies that they're proposing, I think is going to be difficult. So I think there's kind of a. I'm really intrigued to see how that plays out. I actually think that the priority would be, um, and maybe this is just my bias, but would be more toward uh, less government spending and lower interest rates in 2025. But we'll see if that happens.
So that's my train of thought as well. It seems like the soft landing we're in right now is great, but then there's a wall right before the plane, and it's a matter of hitting the wall. And after the soft landing, that will be the recession or depression if things will turn to the worst. And hopefully we can avoid that. But in my mind, you know, I think it's a necessary evil to go through some sort of a depressionary or recessionary environments to make sure that we get on the wood footing and we don't just kick the can down the road.
Yeah, I mean, definitely from the Fed, even the Fed's perspective, and Jerome Powell has made statements to this effect, is that they are, I think the Fed is willing to sacrifice at least the housing market and home prices for the sake of lowering inflation. So it's almost, I'm reading between the lines, but I almost think that Jerome Powell would not be mad if there was a correction in home prices, because that would mean that would help on the inflation front. And really, I mean, there's a lot of folks out there, including myself, who think that home prices are overvalued, and we need some sort of correction to come back to normal price to income ratios and affordability. So at least on the housing market front, I think we could see. I'm not sure how we get there, but I think a correction over the next few years would actually be healthy in a way to reset some of those valuation levels in real estate.
Agreed. So what you have tons of indicators. Let's jump to your sort of graphs and charts that you prepared. What indicators are you looking for from the macroeconomics perspective, and how do
Yeah, this
you
is
you know apply it to today's market?
absolutely. Yeah, this is kind of the simple uh, chart that I show to our executives here at auction.com to just show, okay, what's going on in the market, in the macro market, macroeconomy, and real estate market. And green is basically good for the market. Red is bad, indicating. So very simple here, but there's only one red. There used to be a couple reds. Even just last month, the unemployment rate inched into the red territory in the 30-year fixed. A few months ago, I had the 30-year rate as red because we were seeing rates rise. But now those are yellow. The only red is this kind of technical indicator that of the yield curve being inverted, which typically precedes a recession. But we've seen that yield curve inverted now for quite a few months with no recession happening. So this is why, my headline here is soft landing still likely, is you do still see a lot of yellow and a lot of green. Home price appreciation is definitely slowing down. It's now in the single digits, down in the lower left-hand corner. But still, you see homeowners, especially with a lot of equity, and that's that real estate net worth there. That 72%, 73% equity is basically equity as a percentage of value, and that number is it was at 80% way back in like the 50s when people saved a lot more. But it's still very high compared to what we've seen over the last 10 years. So people have a lot of equity in their homes. we're not seeing a lot of foreclosure starts. Now, I do want to dig into this. One of the warning signs I see is we are starting to just see possibly a turning of the corner when it comes to seriously delinquent mortgages, and that's that SDQ rate of, it used to be green, now it's in the yellow, because actually in the third quarter of this year, we did see a slight uptick there. And it stands out to me for several reasons, but we can talk about that a little more. So anyway, this is my view. I mean, what do you see here? What's not clear so you would want to add?
Yeah. So what jumps out at me, I agree with you on the current state of the economy, and unemployment rate is being steady. Um, the consumer sentiment, I don't know. It's I think we're in November, December timeframe now, and it's getting a little bit worse, I guess. There's enough equity to tap into the HELOCs by the consumer with the home price appreciation and the real estate net worth. So that makes sense, and that will alleviate some of the, I guess, delinquencies or going into SDQ status. And I'm curious to know, what are you tracking from SDQ perspective? Are you seeing the first-time home buyers and Ginnie Mae portfolio being more delinquent than, let's say, QM mortgages and Fannie and Freddie portfolio?
Yep,
Let's just
thanks for
start.
that.
Yeah, yeah.
I'll add to that here.
Jump in, right.
Well, so first of all, on the SDQ front, and we can go back to some of those other slides because they're interesting too, but this is data from the Mortgage Bankers Association, their National Delinquency Survey. And this is kind of how we view the distressed market. It's a funnel or a waterfall, however you want to look at it. At the top of the funnel is just 30-day delinquencies. At the bottom of the funnel are properties that actually go to foreclosure auction and are lost to foreclosure. The top of the funnel, actually, we're pretty close to what we were at. I'm using Q1 2020 as a benchmark to just compare where we are now versus then. And we're pretty close. We're about 2.2 million overall delinquencies. The second piece there, the SDQ, the 90-day delinquent loans, that has changed. If we looked at this last quarter, there were about 100,000 fewer SDQs now than there were back in Q1 2020. But now that we saw an uptick in the third quarter, and now we actually see slightly more SDQ inventory now than we did back in 2020. So that's an indication to me that maybe some of this delinquency is moving down the funnel from the top of the funnel down. Now, we're still not seeing it show up really in foreclosure inventory or foreclosures brought to auction. Those numbers are still way below their 2020 levels, even though the top of the funnel is the same. So I think that's really interesting. And then to answer your question here, your more specific question, delinquency by loan type, the red is kind of the Jenny's stuff. It's the FHA specifically. And you consistently see a higher seriously delinquent rate with FHA. And the yellow there is VA. Both of those consistently historically have a higher SDQ rate just because of the nature of the borrowers. But what stands out to me is you see, even across conventional loans, which is the blue line, you do see, the blue line is all loans. And so I take that back. Conventional loans, you don't see this turn, but if you look at FHA and VA as a canary in the coal mine, potentially, on the right-hand side, you see a 14% year-over-year increase in VA seriously delinquent rates and a 9% year-over-year increase in the FHA. And that stands out because if you look back, there's been basically 13 consecutive quarters before this where we were seeing SDQ rates down across all loan types. So all of a sudden here in the third quarter, we see this potential turning point if this data continues.
I think we've been waiting for that turning point, Daren. Post coming out of COVID relief funds, servicer loss meet measures, the different programs that government launched. And sort of we expected this turning point in September of this year, and now we're seeing that's in November, December of this year. Is that what you kind of read? We have a two months lag from what
Yeah,
we.
this is actually third quarter data. All this data tends to lag a little bit. This is third quarter data, so ending in September. Yeah, and we've kind of been waiting for it for a while, like you said. We've seen if we looked at the 30-day delinquency rates over time, those had been trending up for the last 6 to 12 months. So we were seeing early stage delinquencies trending higher, but we hadn't seen it trickle down to seriously delinquent. But now this could be, I don't want to read too much into one quarter's worth of data, but this could be the turning point we were expecting. And to your point, some of the relief during COVID has gone away. And then you also just have people who were put into loss mitigation and that kicked the can down the road for them, but it didn't solve their underlying problem. And I actually have another slide that shows that here too, I can go to.
And just to summarize, to sort of from the investor perspective, based on this chart, what you're implying is if the trend continues, and you see the trend going on the right-hand side, going from the bottom through the sort of 0% to the higher delinquency rates, and if the trend continues, the foreclosure starts and the auctions would lag probably 6 to 8 months behind. And therefore, in 2025, I guess Q3, you would see a big uptick in the foreclosure properties going to the auctions. So for investors that are eyeing that point, when can they get into the market and start funding or looking for funds for acquiring properties? I think Q3 of 2025 would be the good bet that the properties will start to trickle in.
Yeah, I think that's very spot on. You nailed it with that, because it's going to take a while for this to flow through to actual foreclosure. And I don't want to overstate either. This isn't like all of a sudden this huge increase. We're coming off of a 40-year low in seriously delinquent rate in the second quarter. But still, it does stand out because it's not just a quarter-over-quarter increase, but it is a year-over-year increase, which is the first one we've seen in 3 years, basically. So that stands out. But yes, it's in terms of actual foreclosure acquisition opportunities for investors, I wouldn't expect that to increase corresponding to this increase until late 2024. I think the third quarter is a great time to really start looking carefully at that.
2025 there, right?
2025, I'm sorry.
Yeah, right. Okay.
Yeah.
All right. So what is the next slide that you wanted to show as far as the, okay.
Yeah, so there's a lot in here, but, well, actually, we should look at this one because this is one of the reasons that we expected SDQ rates to go higher at some point. This is also data from the MBA, but if you look at it by vintage, SDQ rate by vintage of loan, the recent vintages loans, 2022, 2021, and even 2023, 2024 is really early, so vintage. But all of those lines there at the bottom are running higher than the 2012 to 2018 average. So recent vintage loans are performing worse really than loans that we saw, the performance of loans from 2012 to 2018. So that's an indication that some of these recent purchases near the top of the market are more at risk for delinquency. And that's one of the reasons we've expected this increase at some point is because some of those recent vintages are coming up. On the right-hand side, a little hard to see, but right now, 29% of all SDQs are loans that were originated in the past 5 years. But if you look at FHA specifically, it's 40% were originated in the last 5 years and 56% for VA loans. So those are the higher risk loans. And we're not as much, we're still dealing with stuff from the last crisis, but it's more shifting to recent vintages, people who bought with low down payments near the top of the market in the last few years.
Now, the trend does not tell the story on the low interest rate mortgages versus folks that try to buy the property during the rise of the interest rates, right? So from 23 to 24, you would expect a higher delinquency because the interest rates were pretty high, right? Is that what the graph shows, or it's too early to say?
I think 24 is a little too early to say. 2022 is really the worst performing year over right now over the last few years. And I think that does have to do somewhat with interest rates spiking in 2022. Um, so that's, and you did see home price appreciation slow down in 2023. So those people who bought in 2022 haven't built up as much equity as you might usually see.
Are you implying they're below water on the home price to the mortgage?
Sorry, say that again.
Are they below the water on the home price versus the
I
mortgage?
think there are more of them. It's a higher percentage that are underwater. Not everybody who bought is underwater, and especially if you bought with an FHA loan or VA loan, which, you know, with FHA, it's 3% down, or sometimes you can get down payment assistance and have nothing down. VA, you can have nothing down. So you don't have a lot of equity to start with. So there is a lot more risk for underwater with those loans.
Yeah, I mean, from my own experience, we invested in various properties in 2022, and we did see in Florida, and we did see, I'd say, 20 to 25% appreciation, and now it's coming down. So looking back, that might not be a super smart investment. Maybe investing in Bitcoin would be better, but yeah, we can definitely, from my own perspective, tell the same story that the prices are coming down. They're getting to the level of 2022, and then if you bought in the wrong time, you're pretty much underwater for the next, probably year or two. If you bought after 2022,
Yeah,
at the
and for someone who an FHA borrower or VA borrower who's kind of on the margins anyway, or financially stressed anyway, financially stretched, that could be a bigger deal, than someone like yourself who's an investor who might be willing to ride out and wait for the home prices to rebound.
Yeah, agreed. Okay, so go ahead.
Yeah, I was gonna just mention this. This is another reason that we do think that, um, at least those seriously delinquent rates will continue to rise in 2025. This is data from FHA itself. It's called HUD Neighborhood Watch. It's a free site you can go into and look at some of this data. But if you look at the key piece on this is the right hand chart, which shows the FHA loss mitigation failures. So these are folks who have gone through loss mitigation, have gotten either a loan modification or done a partial claim to avoid foreclosure. But then they've gone through that cycle and it hasn't worked. It hasn't saved them. So they've exited loss mitigation as a failure. And those numbers, the green bars there basically are going up, trending higher. And so that's another reason that some of these, we expect those SDQ rates to go up.
What's the scale of the right column? So it's 800,000 loans or borrowers, or
The right axis is just overall seriously delinquent mortgages, and the red line there. So we're at about 300,000 overall SDQs. But then we're seeing about the green bars is tied to the left axis. So we're seeing right now around 30,000 loss mitigation failures a month, with the FHA loan specifically.
So in other words, if we translate that to future foreclosure market, 30,000 properties, the borrower exhausted all their loss meet options. They failed in the last one. They probably have a partial claim mortgage or some sort of the assistance mortgage which is junior to a primary or first position, which will get later wiped off in the foreclosure. And the lender or investor will have no other loss mitigation measures but to foreclose on the property 6 to 8 months down the line. Is that how you read this?
That's basically the only other thing I would add is the homeowners would have a chance to sell before foreclosure if they choose to. And we are seeing more what we call these pre-foreclosure sales where homeowners are selling prior to the foreclosure auction. But yes, basically that's the narrative that we're seeing with these.
Do those borrowers have a real estate wealth equity to tap into the additional HELOCs?
That's a great question. And actually, a lot of them do. And I think sometimes they don't know it, or they're willing to, they have a psychology where they just want to stay in the home. They want to stay where they are. And so they're willing to, in a sense, trade their equity for staying in the home for as long as they can. But yeah, I mean, one of the reasons we know they have equity is an amazing, about 60% of the properties that are sold on auction.com at foreclosure auction, they sell above the total debt that's owed to the foreclosing lender. And so that's an indication that the home had some equity. And it's, one piece of good news there, if I haven't mentioned it before on your podcast, is those homeowners, if there is a surplus at the auction above the total debt owed, that surplus actually goes back to the homeowner. So they do walk away with equity. But a lot of people when I bring that data to our clients who are servicers, they're kind of amazed because it's like, why would anybody allow their home to be foreclosed when it has equity? But yes, the short answer is, yeah, I mean, a lot of these folks, because of the run up in prices, actually do have some equity in the homes. It's sometimes hard to determine. It sometimes looks on paper like they have a lot more equity than they actually do, because if you just use like a automated valuation of the home, because these homes a lot of times are in pretty highly distressed condition. And so the automated value of the home is not really accurate. But still, even with, our buyers who evaluate the home, drive by it, are aware of its true value in its as is condition. 60% of the time, they're willing to pay more than what's owed to the lender.
That makes sense. And the reason probably why the borrowers are not going out and getting the HELOCs, A, they need more education on where to go and how to get it. B, I don't know if there's programs out there that would allow them to be qualified for the HELOC.
Right. I would say the qualification is going to be tough because a lot of these folks, and they have lost their source of income or the income's been reduced.
Yeah, I mean, the lender will hit the credit and they see that they're delinquent on the first lien. So why would they originate the HELOC when they know they're not paying? So there's these type of considerations are being done by HELOC lenders on origination, and probably that's why they can get the HELOCs. Agreed that they do have some equity. I think there are some lenders out there with a high interest rate above 10-12% that will allow a risky HELOC to get forward to current. But again, it's a high risk play, high reward if that works out. But certainly education.
And at the end of the day, is that may not always be the best option for the homeowner. That's, again, just kicking the can down the road a little further if it's not a long-term solution to their problem.
Yep, completely agreed. So do you have any data on the consumer debt or sort of distress of the consumer, and what is the state of the home buyer or borrower at the current moments?
Sure. Yeah, well, okay, so a couple things here, Bruce, real quick. We are seeing, these are bankruptcy filings, which is kind of a sign of stress on the consumer. We haven't seen like a huge wave of those, but they've steadily been climbing and been up they were up for the 27th consecutive month on a year-over-year basis in October. So those are going up. Those indicate homeowners are kind of the end of their rope, unfortunately, and are filing bankruptcy to avoid foreclosure. And then this report just came out recently. This is from the Federal Reserve, the household debt report. And I found a couple things in this pretty interesting. So you see consumer debt by type there in the chart. And we had been for quite a few months here. If you look at that blue line, which is the credit card debt, or this is not debt, it's 90 days delinquent rates, which the total debt is also going up at record highs. But the actual delinquency rate at credit cards, and if you look at auto loans, the green line, those have both been rising for quite a while now, since 2023, really. But it's hard to see in the chart. We hadn't seen that really translate into mortgage delinquencies until, again, this quarter. I feel like the third quarter is a little bit of potentially a turning point. And it's hard to see in the line there, the yellow orangish line with mortgage. But we did see that the SDQ, this is the new SDQ, the Federal Reserve calls it new SDQs rate, inflow to SDQ. And it was up 50% on a percentage basis. It went up from 0.72% in the third quarter of 2023 to 1.08% in the third quarter of 2024. So that was something that stood out here, is that we're actually seeing some of this consumer debt stress that we'd have been seeing for some time, potentially now ripple out to mortgage debt as well. And so that's, yeah, definitely. You see it in the table there on the lower right. Home equity is up a little bit as well. But
So the mortgage and home equity trends together, right? You see a slight increase, not as proportional to credit card, auto, and the blue line is, okay, credit card, right?
yeah,
And the green line is auto, and the gray line is other, which is,
yeah, other consumer debt.
right. Okay. So you see a very similar to 2008's relationship, right? Where the same trends, except for mortgages, right? So mortgages trended up in 2008, a great financial crisis. And here it's the everything but mortgages are trending up. Well, slightly trending up in the past quarter, but not as much as in 2008.
Yeah, 2008, I think it's pretty clear that kind of the mortgage delinquencies almost led the way, or at least were parallel to some of the other consumer debt. And we have not seen that this time around. The theory being, I think, the equity that we talked about, home price, we haven't seen a home price crash. So these homeowners have equity, and then also just stronger lending standards. So the folks who are in these mortgages have pretty high credit scores, very high credit scores. And so that's been the theory, but we have believed that the pressure on consumer finances would likely, at least at some point, ripple out to a certain extent to mortgage debt as well.
So you think there's a delay in the mortgage delinquency that will translate to 2025 probably, because the
homeowners have been more insulated. They tend to be, wealthier, have the equity. But I'm not proposing that we're going to see something like 2008 or anything like that. But in this case, we would expect some of the stress that's showing up to ripple out to the homeowners and mortgage debt as well.
Are you surprised that student debt is not rising?
Well, that's a little bit, it's a little confusing because of the student loan forgiveness that's been thrown out there over the last few years. And so that one, I think, is influenced by that. That's why you see that sharp drop off in student loan delinquency rates. And I don't, I'm not sure what's going to happen there, but based on policy and, I think could see a shift in policy there and forgiving student loan debt going
Understood.
forward.
So let's touch on the trends that you see translating to 2025. So what is sort of your prediction on what we discussed? I mean, I know that it's hard to predict with a new president coming in the White House, but you know, highlighting some of the things that you would expect from the new administration and how it translates to real estate and of course to your business at auction.com as foreclosures and pre-foreclosure sales.
Yeah, I'll start with the foreclosure piece, but then broaden out to the larger market. This is just showing auction.com volume basically and benchmarked to Q1 2020. And the green line is foreclosure auctions that we do, and the blue line is REO auctions that we do. And those are running about 40%. They kind of plateaued at 40% of pre-pandemic levels, meaning another way of saying it is they're 60% below pre-pandemic levels. So we certainly haven't seen a wave of foreclosures coming out of the pandemic. And actually, I would expect this to continue for most of 2025 because even though if we see that rise in seriously delinquent rates continue, as we've talked about before, that would show up eventually at foreclosure auction, but probably not until the end of 2025 and into 26, where we'd really see that come. So right now, we're planning on this line to basically remain flat. Both of these lines basically remain flat in 2025 in terms of volume. I do want to point out real quick that this is that same data, but by state for the third quarter. There are some states where we have seen foreclosure volume return more quickly. And so that's something to keep aware of as an investor. I mean, there's still foreclosure volume everywhere, even in Florida, but Florida is only at 24% of its pre-pandemic levels. So it's almost 80% below pre-pandemic levels. But then if you look like a state like Indiana, 85%, Colorado, 93%. California is even higher at 60% of its pre-pandemic levels. So it does vary depending on how the foreclosure process works and other variables as well. But we would expect these numbers to hold pretty steady through most of 25. I actually am expecting to see Florida, that 24% rise in Florida in 2025, but most of these states will remain
Does that
kind of
follow
muted
the price appreciation per states, and the more appreciated prices in a given state will translate to a lower foreclosure rates because of the equity?
That's the initial thought, but in looking at this a little more carefully, I actually think it has more to do with the foreclosure process in the states. So the states that have a judicial foreclosure process tend to be in the blue. And that's the judicial foreclosure process is a longer process where it goes through a court to make it to foreclosure. And so that's Florida is an example of that. New York and New Jersey. New Jersey is at 21% of pre-pandemic levels. So I think it actually has a little bit more to do with the foreclosure process, because you see in California, which has also seen pretty good home price appreciation, we're at a much higher level, and California has what's called a non-judicial foreclosure process, where the process can happen faster. So I actually think at the end of the day, it has a little bit more to do with that than equity. And so I think in a state like Florida, even though it has a very healthy real estate, or it has had a very healthy real estate market, although there's some cracks starting to emerge there, that there's a little bit of so-called shadow inventory in a state like that that's been held back, but that will eventually make it out in 2025. But then this bigger trend of rising delinquencies that we're potentially seeing the beginning of, that won't really translate into rising foreclosure volume until late 2025 across the country.
Now, if you look at the states that are above 100%, is that sort of a trigger for the investor that this is a great state to come in and start bidding on real estate properties?
Yeah, I would say that's at least one indicator that, hey, there's more inventory there. And we encourage, our investors, our buyers are always asking for more inventory. And a lot of our buyers tend to buy in the markets they know, which makes sense, and kind of in markets that are close to them. But we're encouraging our buyers to look outside of their market. They can do that with our REO auctions. Those are all online, so you can buy anywhere in the country online. Now you have to do your due diligence, of course, but and then we have for foreclosure auctions, which traditionally are at the courthouse steps. We have introduced a technology in the last few years called remote bid, where you can actually still bid remotely on those auctions. You don't have to be there physically, so that's allowing buyers to look in different areas. And one thing I would notice, one trend that we're seeing is more rural foreclosures. If you take out even the state designation, properties that are in rural areas we're seeing the foreclosures go up on those more than in suburban and urban areas.
Understood. Darren, let's dive into two topics. Very interesting to me. Investor, I guess, behavior in the current year, and the sheer number of investors that are logging in and creating an account at auction.com, as well as solving an issue of putting in escrow money with each jurisdictions you want to bid, rather than opening an account with auction.com and having a single escrow and ability to bid in multiple jurisdictions. Am I hearing you correctly that that's the function that you just introduced? So an ability to bid through auction.com with the single escrow account, rather than logging into each jurisdiction to bid and maintaining the escrow to have the right to bid within each jurisdiction.
Yeah, that's basically it with this remote bid, which is available in about 1,000 counties across the country.
Okay.
Through auction.com is, you have an escrow account where you put in your funds, because as you probably know, in most states, if you're the winning bidder at foreclosure auction, you have to present the funds right there on the spot. And historically, that's been done in the form of cashier's checks. So what remote bid does is you put your funds into this escrow account, and then you can bid on properties in different locations. You don't have to be there physically. And if you're the winning bidder in one location, rather than having to have, let's say you're interested in 5 properties in 5 different counties. In the old system, you'd have to have yourself or someone on your behalf go to all 5 of those counties. If at the end, theoretically, these are all on the same day, and have cashier's checks to cover all the funds for all those 5 properties. In this scenario, you could have, let's say each property is $100,000. You put $500,000. Well, you only plan to buy one property. You only have to put the $100,000 into your escrow, rather than put out there $500,000 in cashier's check, not knowing which property you'll end up being the winning bidder on, if that makes sense. So it does. Our buyers have found it to be very beneficial in terms of deploying their capital more efficiently.
Just to add what you said, as
sure.
far as the benefit that I see, I mean, for somebody who bid on the foreclosure auctions, even without cashier's checks and with the remote bid at the county, I have to first find the properties I like. Then I have to allocate, was it 5 or 10%? I have to wire the money, make sure the wire clears with the county treasurer. Then I have to do it for every property that I like. And then when I don't win the bid, I have to refund the money back to me and then do the same process, which is very inconvenient because
Yeah.
I have to wait 3 days, and the property can go away, say, the 24 hours before the bid. So I sort of freeze my money for 3 days and get it back in another two. Very inconvenient. I'd rather have a single place of escrow where I keep, let's say, a large enough amount of money to be able to freely bid on any property without any delay, while auction.com is maintaining my escrow and representing to the counties that I have enough funds, sufficient funds to go and cover the bid. So that's, to me, if investors are listening to our podcast, I think this is a great service that you guys are offering. And that solves an issue of sending back and forth the money to be able to bid on the properties that I like.
Yeah, I'd love to hear that. And yeah, hopefully, we have a lot of buyers who love it. And even lenders, I've talked to some lenders who are utilizing remote bid to help them fund borrower purchases at foreclosure auction.
Okay.
So that's an interesting take on it. So there's not a lot of lenders who will lend at for a foreclosure auction purchase, and because it's pretty high risk. Although if you have a investor who has done a lot of these in the past, they're pretty safe bet. So anyway, but they'll use the mechanism of remote bid to actually fund those deals more efficiently as well.
That makes sense. I mean, there's a marketplace for the lenders when they're distressed. And there's plenty of private money flowing into that market, hard money lenders. So I think there's plenty of lenders that will play in the distressed marketplace. And I think there's, a bunch of conferences that folks go to get funding to fund the purchases on foreclosure auctions. So that makes a complete sense to me. And again, I applaud auction.com for coming up with a great solution.
Thank you. I mean, that was something that our team came up with. It certainly wasn't my idea, but it was kind of good timing because we launched it right in 2020, and it was at the time when it was actually very beneficial. There was more reasons than just what we're talking about because of the pandemic to not have to go to an auction with a bunch of people, but be able to bid remotely.
Yeah.
So
So let's get back to our sort of. I want to make it the last topic. I know we're running out of time, but let's analyze the investor behavior and what's out there. Maybe your projections on 2025.
we are seeing, I mean, in general, I'll go back here. There's a lot of lines I know on this slide, but basically the takeaway for me is our buyers are still being very cautious. Now, we don't have November data in here yet, but the green and blue lines here are basically what our buyers are willing to pay relative to after repair value. And those lines have been trending downward basically since May of this year. You see the downward trend in both the blue and green on both charts. And I do think the election certainty will help potentially create this kind of Trump bump, and our buyers will jump back in a little bit. But at least up through October, and that had not been happening, which is signaling that they maybe have a similar perspective to what you were talking about earlier, is that the so-called soft landing is maybe not as soft as we might think. So they're a little bit cautious. They're saying, hey, mortgage rates are coming down a little bit. That's the red line, but we're still not convinced that this is going to spark a retail rebound. And then on the right-hand side, I think one of the reasons that they're cautious is also rising inventory of existing homes for sale. So that's also causing them to go down. If you look at this by market, this is a slightly different metric, but on the right-hand side, this is basically our sales rate at foreclosure auction, which is a measure of demand, how much demand there is. And the orange is where we see more increasing demand at foreclosure auction. The blue is where we see decreasing demand. And it's very interesting to me that kind of corresponds to where we see on the left-hand side rising retail inventory in the orange and lower retail inventory in the blue. So they're kind of the reverse of each other. But we tend to see more demand in the right now in the third quarter, at least in the Midwest and Northeast markets for distressed properties, and less demand in places like in the Southeast and Florida, and really across the Sun Belt, that kind of that layer of blue we have across the bottom of the map. So our buyers are overall becoming more conservative and cautious in their bidding, but there are definitely markets where they're more confident, which tends to be in the Midwest and Northeast.
Yeah, the thesis on Florida, that's interesting to me, is that a lot of investors bought the properties too high, they're underwater, or with respect to the condo regulation that requires the HOA assessment to compensate for reassessing the foundation if the property is 20 years or older, and therefore people are just you know giving up those properties, either being too high or properties with a large reassessment, and therefore there's not enough demand there, um, which is reflected on your left hand side. Uh, but the merchandise is there, right? So the um, inventory is quite high, but the demand is not there. Is that how you read this, or
Yeah.
there's something else that is a factor?
No, I think that you hit on a lot of the key issues um, that are driving inventory higher, but then causing at least our buyers, and I think other retail buyers as well, to be more cautious in demand. So, and we're not seeing this spreadsheet or these heat maps here show the pricing element of it. On the right hand side is the auction.com data. It's a little less clear, but where you see the blue is where our buyers are reducing what they're willing to pay for properties, and the green is where they're increasing what they're willing to pay. So you do see in Florida, for instance, you see kind of a combination, but in the markets where our sellers, who are the banks, are willing to reduce their prices a little bit, then our our buyers will ramp up their demand if our sellers start responding to the market as well and reducing their prices, if that makes sense.
Yeah, it does. Okay, so it's really reflecting for the investor, go negotiate in Miami-Dade while you will have tougher time in Tampa area. If you look at the Florida, right? While after the hurricane, maybe that's different now, right? Folks changing their mind and
Right.
saying, well, Tampa is now being hit so many times, and maybe it's not as safe as they thought, and the red circle will now turn into green.
That's right. Yeah, and our sellers tend to be more responsive to the market. They don't live in the home. They're not emotionally tied to it, so they're not always as responsive as we would like. But they tend to be more responsive and say, "Hey, look, if this is what the market is telling us, we actually need to reduce in the auction contest, it's their reserve or their credit bid that they're asking for the property, their minimum amount they're willing to take for the property."
Understood. So let's summarize that what we talked about is that we both feel that foreclosure activity will pick up in Q3 of 2025. There will be more delinquencies coming to the market. The AFHA portfolio delinquencies will continue to grow, and investors will certainly have more opportunity to run deed in lieu of foreclosure in the areas of distress, or the areas based on this chart where there's a lot of inventory, not a lot of buyers. That creates a lot of opportunities for investors, distressed investors, to come in and really, you know, cherry pick the properties that they want to acquire at much lower costs.
That's a really good summary. uh,
Sounds good. Yeah, good.
yeah, yeah, yeah. Great stuff. I'm real happy uh, to share any of the. Actually, I should say the best place to find a lot of the charts and heat maps that I'm sharing here is if you go to auction.com/in the news, or you can follow me on LinkedIn. I post a lot of it there as well. So for folks who are looking to dive deeper.
Yeah, absolutely. And again, if anybody's interested, you can go to auction.com for latest and greatest. LinkedIn, I follow Daren. I follow all his posts. His analytics and analysis on what auction sees. Great info, great charts. Daren, I wanted to thank you for coming on the show. And let's do it next quarter to see if both of us were right in predicting the future in 2025.
Sounds good. Thank you so much, Alex. I appreciate the opportunity.
Thanks, Darren. Take care. Bye.